The document that you're looking at here is also located in our e-learning site if you want to print this off, and the solution is there as well. We're going to be using this sample problem to demonstrate the journal entries that both buyer and seller would be recording for the purchase or sale of inventory. And in this video, we're just going to be looking at the buyer's journal entries. The next video will look at the seller's entries. So in entry 1, Solomon is our seller, selling inventory to Bixby for $150. Here's our terms that we just learned about, 210 net 30. The cost of the inventory to Solomon was $120. Well, if we record that first on the books here of the buyer is only aware of the retail price, $150. The buyer does not know at all how much the seller originally paid to acquire those goods. So what we'll see in our first journal entry is a new asset being created. The buyer is purchasing inventory. So we have a new asset on our books for $150. Now, how do you know whether the buyer is paying cash or on credit? Whenever there are terms stated, as we have here, always make the assumption that that is a purchase on credit. So we've got accounts payable on the credit side. Going down to the second entry, now our buyer, Bixby, is paying freight of $20 on that purchase. And we'll just assume here that the freight is being handled by an independent trucking company like FedEx or UPS. So you might initially think here that if our buyer is paying freight, oh, let's see, maybe I need to debit something like freight expense. That's not what we're going to do. What we're going to be debiting is inventory. And the reason is because inventory is an asset on the balance sheet, and the cost principle requires that all of our assets be recorded at cost. Well, it is now just costing us $20 more to buy this inventory. So it's all part of the cost of acquiring the goods. And it says that we paid the freight, so let's credit cash. All right, in the next entry, number 3, Bixby is going to return $50 of defective inventory to Solomon. And again, Bixby doesn't know how much that inventory had cost Solomon. All we're dealing with is the $50 of retail amount. In this entry, basically all we need to do is flip around part of the entry we made up in number 1. We are getting credit for this return. We haven't paid for the goods yet. So what we're going to do is send the goods back and reduce the amount that we owe. So we'll debit accounts payable to reduce the amount that we owe by the $50 that we're sending back, and inventory is being returned. And that's the third entry. For the fourth entry, Bixby is going to pay Solomon the full amount due within the discount period. Before we jump into the entry, let's see if we can calculate how much Bixby is going to have to pay. We started off with owing the seller $150. But then, after the return, we now only owe Solomon Company $100. Remember that $20 of freight has already been paid first off, and it was paid to an independent trucker, so Solomon here is not really involved. We owe Solomon a total of $100 after the return, and that's the amount that we're going to take our discount on. So we get a 2% discount off of the $100 that we owe to Solomon. 2% of 100 would be a $2 discount, which means we only have to pay $98. In our journal entry, though, first thing we're going to want to do on the debit side is reduce our accounts payable. Are we going to reduce the accounts payable by just $98? No, we're going to reduce accounts payable by the full $100 because we want to reduce the liability all the way down to 0. We want to wipe that out completely. We don't owe Solomon anything anymore. So the cash, though, going out the door is only $98. That means that we now have an unbalanced entry. We need another $2 credit to something. Now here you might be thinking discount or something like that. But again, let me remind you that inventory is an asset which needs to be recorded at cost. So in our journal entry, we are going to credit inventory, not to show that we're sending units back, but to show that we are reducing the cost of our inventory by $2. So if you look in the inventory account now, and let's just focus on entry 1, 3, and 4. We purchased $150 worth of inventory. We returned 50 of it. We took a $2 discount. So the amount of goods in inventory related to what we owe to Solomon is now $98, which is exactly equal to the cash that we ended up paying to Solomon. Again, handle that freight separately because that was going to FedEx or UPS. The amount that we see in the inventory is $98, equal to the cash we paid to Solomon. The additional 20 is, again, what was paid to FedEx. So if you calculate the total amount in inventory, it really amounts to the 98 we paid to Solomon plus 20 that we paid to the independent trucker, or a total of $118 in inventory, which is equal to the $118 of cash paid out.